Good morning, everyone. How's everyone doing today? These lights are really bright. All right, I'm probably going to stand over here. Brock, thanks for having me. Welcome, Milwaukee, to another fun stage, learning, talking real estate. One of my great passions since 2003. When Brock invited me to join you guys today, he asked me to talk a little bit about how we were able to successfully scale real estate, specifically commercial real estate. And that'll be the focus of what we're going to discuss today, amongst other things. So really excited to be here with everybody. Appreciate the energy in the room. And obviously, thanks to the hosts, the sponsors for all making this happen. So why are you guys here? Who is this for, and what are you guys all doing in this room? I'm assuming most of you have a passion or interest in real estate. Is that true? By show of hands? Okay. You guys are here, obviously, as current investors, potential investors, aspiring investors, or investors that are looking to take their current business from what it is today to something that you wish it could be tomorrow. So that's what we're here to discuss today. That's what you're going to get to hear a little bit about. My journey in real estate, a little bit about a few of our successes in real estate, and then obviously we'll finish with the great Q&A, so hopefully we get a chance to have some good discussion. I always like to start out the question of how hard are you willing to work for $50,000? And is anybody willing to work hard for $50,000? How about $100,000? How about $1 million? Right? We're all really willing to work really hard in our minds about earning $1 million or making another $1 million. But the question becomes is where does the roadblock come from when you aspire or have the motivation to when the motivation stops and you aren't able to obviously fulfill that dream, right? What are the roadblocks that happen? Rejection, time, money, commitment, other obligations, distractions, current job, etc. So today we're going to talk a little bit about how hard are you guys willing to work for $1 million, and what does that look like to actually work hard to get to be to earn that next $1 million. So here's a little bit about what we're going to discuss. We're going to talk briefly about my background. That gets a little boring. We're going to talk about, obviously, defining your risk profile. I'm big on discussing risk. I think risk profile is really important to understand who you are as an investor and what's going to let you sleep at night. No one wants to invest in real estate and not sleep. No one wants to invest in real estate and be completely miserable because you've invested in real estate and are scared that tomorrow is going to be your worst day. You should really be focused on your risk profiles, and we're going to talk a little bit about risk adverse, risk profiles as to what makes you a successful real estate investor. You can be anywhere on the spectrum from risk to be involved in real estate. You can scale real estate with any spectrum of risk. You just have to understand where you as the investor are comfortable being. Sorry, we're going to go back one more. There it is. We're going to discuss scaling your real estate business. We're going to talk specifically about syndication. I have grown my entire business by syndication. We're going to talk a little bit more about how you can syndicate, how you syndicate, why you syndicate. Who would make a $50 million investment with zero of your own dollars? Everybody, right? That would be great. Well, that's syndication for you. And we're going to talk a little bit about syndication. We're going to talk about a few of our real estate transactions. We just are breaking ground on, we're just completing ground on $47 million, 200-unit apartment complex in Oak Creek. I put in $500,000 into a $50 million deal. Think about that. I own 50% of that transaction. We're going to discuss creating value, and then we're obviously going to conclude with Q&A. So if you have any questions, you can always shout those out at any time, but you can also save those for the Q&A section. So a little bit about me. I graduated from the George Washington University in 2000. I was a kid from Milwaukee, grew up in Bayside, went to Nicolay High School, graduated in 1996, graduated college in 2000. I had dreams of being a billionaire. I had no money to be a billionaire, but I wanted to be a billionaire, right? There was, I think the song came out, Everyone Wants to Be a Billionaire or something. There was a song at one point. I'm not a good singer either. So I went to work for a family business, and shortly thereafter realized that that was a dead road for me. Being in a family business for me, growing up in a family business, I recognized that this was a short existence for me. And so I told my dad, Dad, in August of 2003, I'm leaving. I'm going to get into real estate. I don't know what I'm going to do in real estate, but I'm going into real estate. I told him that in January of 2003. So what did I do? I started looking around. I found a franchise called the We Buy Ugly Houses, and that's the big billboards that are all over our communities today that says We Buy Ugly Houses, and I brought that to the state of Wisconsin in 2003, August of 2003. I opened up the first franchise of the We Buy Ugly Houses, and what did I know once I paid my franchise fee? The same thing I learned before I paid the franchise fee, nothing. So I went and I said, okay, I'm gonna learn real estate. So I, on a risk profile, which we'll discuss, am a massive risk taker, and I'd like to be rewarded for my massive risk. And so what did I do? I bought a franchise. I started spending, yes, you got it, $20,000 a month on billboards and direct mail. This was before telemarketers, VAs, dialers were even existing for our industry. And I started flipping houses. So in August of 2003, I had my little phone. It was called the Buy Phone. I had 1-800-44-BUYER. And my phone started ringing off of my $20,000 a month advertisements, and I started buying houses. And what I realized at that point when I was buying houses was, holy hell, this is a great opportunity, but rejection is really fun, right? Because I went and made 100 offers, and how many of those did I get accepted? 3. Maybe 4. Some weeks were 4, some weeks were 3. But I realized that every single week I had to make 100 offers if I wanted to buy 3 houses. Remember we talked about motivation, how hard will you work for $1 million before you quit? So after you get to your first 97 rejections for the week, what did you do? Most people went home. I went and got the last 3 offers, and I got those under contract. I ended up closing on them. Before wholesaling was really a thing, I was wholesaling houses in 2003. I had carbon copy, 3-ply, Wisconsin State Bar forms. I was filling them out. Hey, thank you for your home. Here's your contract. On the yellow form, I was taking the pink to the title company, and the white was staying with me as the original. And we would close on the house. We would either determine that we're going to wholesale it by selling it to another real estate investor. Everyone's familiar with wholesaling because everyone watches Instagram, and God, are those annoying ads going crazy right now, but they're out there, right? Everyone knows wholesaling. Wholesaling from a risk level is very low, right? You have to know nothing about real estate. You can buy a contract, hopefully find someone to buy it from you, and then you can go on your way. Well, I was buying the houses. I started flipping the houses. I started creating value. In 2005, I stumbled upon a duplex that I paid $14,000 for. The tenant on the lower floor was paying $625. On the upper floor, they were paying, $625. It was a family. And I was like, wow, for 14 grand, they're paying me $1,200 a month. This is pretty good. After that, the wheels started turning into how can I build my rental portfolio? And so that's when the lessons started clicking. So fast forward, I was with Homevestors. I flipped about 150 houses with Homevestors from 2003 to 2009. They became insolvent as a result of some other issues, and I exited peacefully with them and only wish them the best. They've started me out. They're a great company and a great marketing vessel. After that, I acquired a bunch of that duplex, started flipping houses, started building up a rental portfolio. In January of 2010, I bought 440 apartments in 1 week. That was the moment that took me from holy hell to where are you going, kid? And so I woke up on January 17th of 2010. I had 440 new doors. I had no management company. I had nothing to do. I was scared shitless. I didn't know what was going to be my next move, but I said, I paid $9,000 a door, and I knew I just got something. How many $9,000 doors can you buy today? 0. But I bought 400 units for $9,000 a door. They were 30% occupied. They have massive litigation. I bought them out of a receivership from the Milwaukee County court system. And from there, I elevated those units and learned what syndication was. How do you close on 440 units in 2 weeks with no debt? You syndicate. We'll talk more about that. So syndicating off of those units, those 440 units, turned me into then 440. I turned into 1,500 apartments, all Class B, Class C apartments. After you do that for 15 years, you realize that you're about to kill yourself or something's bad's about to happen. So I sold all of those units last year to, you got it, Joe Barata bought all of my apartments, all of my Class B and C apartments in June of 2022. And so No longer have those apartments. In 2009, I created F Street. When I left HomeVestors, I loved their model. Their model was, you as a franchisee, we'll lend you money. And I said, well, when I was a franchisee, I didn't know anything, but I guess I could borrow money from you. And so I took the model and I lent money to other franchisees in the program. My first loans were in Austin, Texas. And then I created what was Milwaukee Hard Money in the local market that we're in today. And since then, our marketing team has changed our business from Milwaukee Hard Money to the hardmoneyco.com, and we're now a regional hard money lender. We averaged, last year alone, we did 535 loans. So it's all about scale for me, right? It gets real boring real quick watching paint dry. So I want to keep moving. I want to keep growing. I want to keep developing. I want to keep building. And I want to keep aspiring to the next phase of my life to hopefully one day, I don't know, be a billionaire. We'll see. So a little bit about F Street. So F Street was founded in 2009. We have 4 different verticals that we focus on. One is the Hard Money Co. The other one is F Street Development. F Street Development builds ground up multifamily and ground up industrial. Right now, I have 1.3 million square feet of ground up industrial, spec industrial being built today in Appleton, Wisconsin, in Germantown, Wisconsin, and St. Augusta, Minnesota. So I'm swinging for the fences. Sure. Is it calculated? Sure. Is it 1.3 million square feet scary? Sure. Yes, all of that is happening. I have 0 tenants today for 1.3 million square feet. That is a bad percentage. But I just signed an RFP last night for 100,000 feet of one of those buildings, 250,000 feet. I'm very optimistic I'm going to get all of these full. And when they're all full, the value we'll have created is over $50 million. So you can sit on the sidelines or you can try to make $50 million. You guys decide. It's all about your risk profile, which we're going to talk about in a little bit. Then we have F Street Investments. F Street Investments is our lending business. So I talk a lot about risk, and I think this is the most important, right? So where are you on the risk spectrum? How many people are risk takers? How many people are risk adverse? How many people think they're risk takers but are really risk adverse? Because probably most of the risk takers are really risk adverse. They just don't know the difference yet. How many risk takers are accountants? Should be none. So this is the biggest, one of the biggest aha moments you should gather from being a real estate investor, in my opinion. Knowing where you fit in the spectrum of real estate is okay. It's really clarifying for you as to how you can become successful. If you are not comfortable with a lease up and you're not comfortable with vacancy and you're not comfortable worrying about when your cash flow runs out, what are you going to do, and don't have a plan to do so, you should be on the risk adverse side of things. And that's okay, right? There is a real estate investor that is risk adverse that does very well in our industry. People that own Walgreens, right? There's a huge market for people trading 1031s, triple net leases. Does everyone know what a triple net lease is? Tenant pays everything, you just get a rent payment, you pay your mortgage, from your mortgage, you keep the cash flow. It works really well. Your return from the risk adverse is significantly lower than the person who's taking the risk. Risk, reward. Everyone's heard that saying for their whole lives probably. The more risk you take, the more reward you're going to make, right? And that's true. And there's also people that get over their skis with risk, and then what do? They fall down the hill. And that's where you have to be able to balance the paradigm between risk-taking and obviously not pushing yourself too far. And so what do I do as a risk taker? We manage our sources and uses of capital incredibly well. We put a spectrum out there. How long do you think I give myself to lease up a vacant, brand new industrial building? 2 years, 24 months. If I finish it earlier, I save my investors $600,000 to $800,000 of interest. I have a building in Appleton that's vacant today. I got a call from a pallet company. They store pallets. Think about that business. They need 200,000 feet. They're paying us $850 a foot, $120-some thousand a month to store their pallets. I have no other tenant. We've agreed to a short-term lease. They're on a 3-month lease, and they have to give me 3 months' notice to move out. So that's really a 6-month lease, but that's still good. And so what am I doing? I'm taking the $126,000 a month I'm getting in rent from them today. I'm putting it in my interest reserves to beef that up. So now I've got every month that goes on, my 2 years continues to go forward. But what's going to happen? I'm going to get a tenant. I just signed an RFP for one of the tenants yesterday. Once I do that, all of the extra money that was probably $600,000 of interest expense is then going to be $800,000 or $900,000 of interest expense that my syndicated investors are going to receive back. Make sense? So if you're risk adverse, if you're the folks that don't want to, if you're risk adverse, you're going to be buying properties on the east side. You're going to be buying properties in Shorewood. You're going to be buying properties in the suburbs. And you're going to be getting a 6 cap, a 5 cap, a 7 cap. If you're open to risk, you're a risk taker, you might buy something like I did. You might buy inner city or city properties that you can earn 12, 15, 18 caps. But you're going to have different risk profiles. We'll talk more about this in a little bit. So, we're going to talk more about it right now. So, risk takers are those that are doing the fix and flips, right? How many people have flipped a house? How many people have ran into problems while they were flipping the house? Foundation we didn't know about, the roof wasn't leaking, now it is. The city inspector is a total mean person. I got hit with a bill. I didn't pull permits and should have pulled permits. The previous deal was not done right. How many people have had those problems? You guys as flippers are risk takers. I saw Tony around here somewhere. So Tony is a young aspiring real estate investor who has spent time wholesaling, right? My son bought a flip from Tony, and Tony made $15,000 measly on the flip. Tony's not a risk taker. Tony was a widget maker. He took the house and he passed it on to me, who's going to assemble it into the house or the car or whatever widget you wanted to call it. So my son took that house on South 81st Street, which he paid Tony. Tony bought it for a great price, $40,000. Tony sold it to me for $55,000. So I paid him a $15,000 assignment fee. And we put $80,000 into it and sold it for $239,000. Thank you, Tony. So risk taker was us who put all the time, energy, risk, market into it, sold it, and made $50,000 or $60,000 at the end of the day. Tony made $15,000. Different risk profiles. How many people have done ground-up development? Probably the riskiest part of the entire business is multifamily ground-up development. All of my guarantees that sit with banks today is all based on completion guarantees. All they want is a finished product with a certificate of occupancy. Why is that? Well, bankers are what? Risk adverse, just by trait, right? That's who they are. They don't know how to do anything. Let me take that back. They don't know how to do anything in building, and they don't know how to complete a project. So that my guarantee holds them to a position where once I complete the building, my guarantee goes away. That's a completion guarantee. So I'm willing to sign that guarantee, and the banks are willing to work with us. Once the building's built, how hard is it to lease a Class A suburban apartment building in today's market? Relatively easy. Ask Adam McCarthy. He's somewhere. He's probably done that once. Right? What about commercial real estate? Capital intensive, requires personal guarantees, lease up, lease cycling, renewing the tenants, extending leases, dealing with TI, dealing with brokers, dealing with commissions, dealing with insurance companies, you name it, right? The risk taker is doing all three of these. If you are not a risk taker, stay in your lane. This is going to keep you up at night, might drive you crazy, put you into a mental ward. I don't know. It does happen. So, risk adverse. Who's bought a turnkey apartment building? Generating income off of it. Nothing wrong with that, right? Produces cash flow, pays down your debt, builds wealth, right? Everything's great there. So if you're buying a turnkey building, it's great. There's people that are buying those, but what cap rates are you buying those at? 4s, which was a year ago, for multifamily. 6s for industrial. That's all changed, but you understand the difference, right? You build to an 8, 9, 10 cap, you can sell for a 4, 5, 6 cap. You can understand the power of the cap rate and the money. Buy and hold strategy. How many people are just looking to accumulate 5 new doors a year for the next 10 years and have $20 million of net worth in their business at the end of 2035? I am. Someone else has got to be. If you're here, you want money. You want something. You want wealth. You can create it very slow and steady. Remember, the internet is probably the biggest problem for us real estate investors, because you see the Lamborghinis, you see the fast cars, you see the money, you see all of the fame, and it's all bullshit because it doesn't happen that fast. It doesn't happen in a 30-second reel. It actually happens in like a 15 to 20-year life cycle, believe it or not. So people that are buying real estate today are taking the risk for tomorrow. That's what we have to remember. I wanted to go back for 1 second. So how many people are also investing in other items that are passive income, passive investments to them? Passive meaning you don't have to do much. You're being part of a syndication. You're investing in other cash flow opportunities. Anyone else involved in passive investments? Right, and those are great, right? That helps for me as a risk taker. I make passive investments with other GPs or other sponsors or other private equity or other venture funds because it diversifies my craziness, right? It makes all of the crazy stuff that I do look really normal over there at XYZ Fund, right? So balance, 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 get to where you can be. So what do you do today to start growing your business? What do you do to scale your real estate business? What do you do to become a better you and better wealth creator? Well, the first thing you guys all did was come here today. So Brock, congratulations on getting everyone here. Attend events. Is this anyone's first event? These lights are killers. It's your first event. Thanks for coming. They should be thanking you, but it's nice to see you, so thanks for coming. How many people attend these regularly, 2, 3 times a year? How many people are part of masterminds, YPOs, other boardrooms, other events? Those are great places to connect with like-minded individuals. Proximity is important. Like-minded individuals are important to be with. If you can get in a room with them for wherever you are and you can talk turkey, it's great. Talking turkey with a bunch of losers is not good. Obviously, education. How many people are involved in any of these educational series? How many people have mentors, mentee programs? Right? I would just mind you a quick story, so I digress for 2 minutes. There is a local real estate investor who is a mentor. He has that in his name, and I just finished foreclosing on him because he couldn't pay his bills and he couldn't figure out, but he's a mentor for real estate fix and flipping and wealth generation. The reason I tell you that is ask the hard questions of your potential mentor or person you want to learn from. Ask the questions. Do a background check. If you run CCAP or run a background check, it could cost you $5 to $35 and it'll save you $8 to $10 to $50,000 of nonsense later. Who wants to do business with someone that is failing? I hope nobody. But this scrupulous individual is preying upon people at this point, and it bothers me tremendously. That's why I share it with you, only to say there are great mentors out there. There are people that are willing to invest their time to make you a better person. But make sure that the time that they're sharing with you is successful time, not time with their failures. It's not do as I say, not as I do type of business. Do as I say and do as I do. And that will get you to the finish line. One of my strong, firm beliefs is I always will take care of my investors as a priority to me. My investors are my life. They should be your life too. My lenders are my life. I would never, ever, and I've never, ever have been a minute late on a payment ever in 20 years, and I never will be. Because when you need a favor from them, hey, Mr. Lender, who I've been loyal to for 20 years, I need a favor. Can you increase my leverage from 70 to 75 on this deal so we can make this work? That sounds like a good idea. Networking. How many people go to networking events, right? Go knock around, have a couple cocktails with people. I encourage you to be out as much as you can. That's part of your schedule. Networking, socializing, being part of with people. You never know who you're going to meet. I was at a brewery in 2008, and I met this intoxicated at the time young gentleman who had a physical disability, and he wanted my ear, and I gave him my time. And Tuesday, the following week, he just received his settlement from his bike accident that he was involved in, which created his physical disability, and he gave me a check for $2.5 million to invest for him. If I wouldn't have been there, I would have never known the guy. If I went to talk to the drunken fool, I would have never gotten the $2.5 million from him, and he's one of my good friends today, but that's how it starts. Give everyone the time. You never know who you're talking to. You never know. And in this case, this guy, he didn't know who he was at the time because of the beer was talking for him, but he knew to call me on Monday morning. He showed up to my office Monday morning. He brought me a $2.5 million check to go and invest from him. And over the years, he's made a bunch of money, and so have I. And we've had a great partnership. And then obviously is the self-evaluation, figuring out who you are as a person, where your risk profiles are, what you want to actually be when you grow up. I always encourage everyone to think about real estate as a wealth generator. It can produce cash flow. Everyone loves cash flow. It also can produce wealth. You can be involved in it full-time, part-time. There's no barrier to entry. You don't need a license to be an investor. It is the greatest business in America. It is what defines America. For everyone, all the time. You can invest tonight, tomorrow. You can invest in a syndication. Now you can invest through crypto. You can invest through partial shares. You can buy whatever. This is the greatest industry in the world. And you should be so thankful that you get a chance to be part of it, but find your place. Think about what's right for you. Don't get out of your lane. You can get uncomfortable, but don't get out of your lane. So this slide has one word that's missing from it, and we're going to talk about syndication. But how do you scale real estate? How did Ray Kroc scale McDonald's? Or how did Kurt Culver scale or whatever his name is, scale Culver's? It wasn't by accident. It doesn't just happen. I always tell people when I first started with HomeVestors in 2003, the first thing I did was hire an administrative assistant, and I got a phone system. People were like, you're nuts. What do you want the overhead for? No franchisee was getting that. But I thought it was important that I had a system in place to start building a business. So you have to make investments. So you have to develop your infrastructure. Spend some money. It's okay. If you don't have the money today to spend, save for it. Find a mother, a brother, a sister, an uncle, an aunt. Give them your business plan and invest in developing your infrastructure. Then you got to invest in yourself. Right? We talked a little bit about that, but going to masterminds, talking to other like-minded individuals, figuring out who the lenders are. I go to lunch. I use lunch as my invest in me and my network time. I love lunch. I go every day, and I try to be with somebody. And then part of that is really building your investor network. I started my lending business in 2009 with $700,000 from 3 different individuals. Today, I have $90 million in our lending fund. Think about the numbers. 700,000 start, 90 million today. My goal, I know you were going to ask, is to get to 200 in the short term and $1 billion long term. We're in 5 markets. The United States is a massive place. We have over 500 active loans. I'm always communicating with my investors and my network. Last month alone, in our lending business, we raised over $2 million. Last month, September, this month, we will raise over $2 million from an email that we sent out. That feels really good. That means people trust Scott. That means people trust what we're doing. We pay out $600,000 a month in interest returns to our investors every month, and I've never missed a payment since I started. And I never will. And my investors know that. That's why they come to Scott. So along the way, building my investor network. What is the greatest part of building your investor network? You got it, the referral. Hey, Brock, meet Jeff. Jeff, I invest with Scott. You should too. And that person is writing me a check for $250,000, $500,000. It's the most crazy thing you've ever met. I barely shook his hand and I have a $500,000 check from the guy. At the brewery, I barely met the drunken fool and he gave me a check for $2.5 million. Pretty crazy, right? How many times you guys go out to lunch or dinner and you say, you split it up, and you're like, oh, I wouldn't give that guy 15 bucks, but this guy's giving me $2.5 million. I just met him yesterday. It's a pretty crazy world. So how do you actually scale? I scale everything. Everything I do is through syndication. Does everyone know what syndication is? If you don't, it is okay. I'm going to tell you, but if you don't know what it is, syndication is a process where general partner, which is myself, creates shares underneath the LP or limited partners, and I syndicate or I raise equity in exchange. I raise dollars, equity, in exchange for equity in the business. I've got a $50 million apartment complex. It needs $12 million of LP money. I give them 50% of the deal. I pay them a preferred return, 7%, 8%. I pay them back all of their $12 million, and then guess who gets to keep the other 50%? Me. And of that, I have $500,000 invested. So how many times can you make a $500,000 investment into and own $25 million apartment complex? It's pretty crazy. When I build my industrial buildings, sometimes they get so oversubscribed that I'm not even allowed to make an investment. So I'll build a $28 million warehouse and I'll have $0 invested. Think about it. Just stop and think about that for 2 minutes. You're going to go and build a $28 million industrial building, 375,000 feet, or you're going to go build a 144 apartment units, or you're going to go build 200 apartment units, or you're going to go build 28 townhomes. I just finished and started building 28 townhomes in Oak Creek. They just started. You can drive to Oak Creek, check it out, by the way. It's a great development. It's right on the lake. 28 townhomes. $12 million. I put in, guess. You got it. $0. I didn't put a nickel into the deal. Not a dollar. I got paid a developer fee, $480,000. I get paid a CM fee to manage the construction on it. I'm paying my investors an 8% preferred return. I have $0 invested in Class A 28 apartments that are worth way more than they're paying for them and way more than I'm paying for them. That's called scaling. Last year alone, we raised $40 million of equity to scale last year. 40 million. That's spread across a couple different developments, but $40 million. Of that dollars, I have $500,000 at risk. Of the $185 million of development I have going on right now, I've got $500,000 in them. That's pretty damn cool. Once it registers, you'll think it's very cool too. So how do you syndicate? How do you even get to the point of syndication? It all starts with the first $700,000 I raised in 2009. It all starts with your mind. Will you ever turn over keys to a lender? You have to always know the answer of that is no. Will you ever fail? The answer is no. Will I ever miss a payment? The answer is, of course not. Have I ever missed a payment? Of course not. Will I ever miss a payment? Absolutely not. It's a non-negotiable. It's one of those things that has to be built into your brain so you never ever miss the thesis behind that statement. Because if you don't have that in your brain, you'll never scale. Come up with another business plan. Go sell ice cream in the ice cream truck. You can never be of the mindset you're going to be defeated and your investors are going to break down. If you lose an investor, if you lose one investor, if you have one person talking shit about you, one person that says, he didn't pay me, he let go, one lender, Tri-City National Bank says, Scott didn't miss a payment, one lender, your days are over. Come up with a different business. It's that simple. Does that make sense to everybody? It is the core of how you scale. I always tell people, I'll flip burgers at Burger King before I miss a payment to my investors. That's the thesis. On the last business day of every single month, if you come to my office and ask anybody, what is that day? That's investor day. Pay them. You know how many investors call me after they get their checks every month? Anybody have a guess? What'd you say? None. These are sleepy investors. Where are they? They're happy because they get a check. It's important for me that I touch them every single month. How do I touch them? With a deposit in their bank account. And then what happens when I say, hey, Mr. Investor, I got a new deal and I want to raise another $7 million. And I say, hey, Mr. Investor, would you consider making another $250,000 investment? Sure. Do you mind if my brother Todd comes in? Love Todd. Haven't met him, but he's for sure welcome. Right? So that's how this business goes. That's how we scale. So we started with $700,000. We have $90 million in our debt fund. We've got $40 million of equity raised last year for our deals. We continue to scale. We continue to grow. We're continuing to evolving. Anytime an investor wants to talk to me, we're talking. We're talking immediately, with urgency, on the phone right now. What do you need? How can I help you? Hey, I got a call yesterday. I was golfing. Didn't play very well, but I was golfing. Brock's a very good golfer, by the way. If you ever want to go play with Brock, he's amazing. And he'll treat you anytime you want to go play. Brock networks through golf. So I got a call. I was on the golf course. My investor called me and said, hey, how you doing? And he said, hey, I'm in Italy. I said, that's great. Are you at the Ryder Cup? And he said, no, I'm in Italy. I said, okay, have a great time. He says, can you put me down for $250,000 into your West Bend project? I said, sure, of course. And he said, okay, bye. Have a great trip. I sent him a text, have a great trip, because I didn't get to tell him that over the phone. So while I was golfing, I raised $250,000 of equity in that 1 second of time. And I'm now growing the portfolio to close on what is going to be another $27 million project. In West Bend, 105 garden-style apartments, a 17.9 IRR, 8% preferred return. And how much money am I putting in this deal? Zero. How much do I own of it? 50% in the future. Wealth creation. By the time I'm involved, the value of this project through 9% annual increases, through rents and rent growth, I will have probably created $10, $15 million of equity, and I get half. How hard are you going to work for $1 million, guys? I think pretty damn hard. So we talk a little bit about infrastructure, and I want to go back to this because I think it's really important. Your team is really important. Investing money in your team and your people is important. How many people have a team? How many people should have a team? All of you. If you're all investing in real estate or doing something, you should have people that you can count on to be more dependable and to be more responsive to your success. So hiring a team, finding the greatest, the best, the greatest people you can find is a challenge. People suck today. We agree? People suck. People suck at the drive-thru at McDonald's. People suck at Starbucks. People suck from dependability. People just are not what they were. They're not dependable. When you find the dependable person, keep them. Well, he wants $10,000 more a year in salary. Who cares? Give him a chance to make $20,000 a year, he or she. Figure it out. Create structure that allows them to develop and grow, just like you. As you grow, they grow. What a win-win. Create the tools, the operational tools, the infrastructure. I've done everything on the cloud. I have 0 servers. I've never had a server. Since 2003, we never have had a server. We've done everything on the cloud. But we've got every single SaaS system. I think we have every single SaaS system, but we have almost every single SaaS system that's out there. Dropbox, Slack, Google Drive, Google Suites. I don't even know what else we have, but we got 50 more, I'm sure, that we pay for somewhere along the lines. Find your strategic partners. Who are your strategic partners in real estate? Number one, your lenders, right? If you don't know your lenders intimately, you have done something wrong. I go out to lunch and dinner with my lenders on a daily, weekly, monthly basis. It is so important to know exactly what they do, what makes them happy, what makes them sad, how can you guys grow together, what's their pain points, what can you do to create opportunity. In 2009, my lender brought me a great opportunity. He sold me 3 duplexes, Tri-City National Bank, for $105,000. 2 in West Dallas and 1 in in River West. And that was just because we were talking, we were networking. And those were worth, I think I just sold them, because I did just sell all of them, for $580,000. Thanks for the call, sir, for the 500 grand. And then obviously be part of your community, be part of your masterminds, be part of your groups, be part of your YPOs, your boardrooms, whatever's out there. There's so many cool people out there. Equally enough, there's so many scammers out there. So be very, very mindful that you're getting good advice from good people. But invest the time, invest in the process. We talked briefly about this, but obviously look at yourself as who you are. Self-evaluation is really important all the time. Our team, I was at a meeting, and my marketing guy who's here today, my main guy, my big cheese over there, said, I'm all in always. I can't be off. I'm always on. And I'm like, God, that's the right way to think, because I'm always on. Are you always on? Are you willing to take the call, communicate, text? Oh, I'm at dinner with no one gives a shit what you're doing. They want to know about them. My guy didn't care that I was golfing. I didn't even tell him I was golfing. He wanted to tell me he wanted to make $250,000 investment, and he's in Italy. Thank you, sir. Have a wonderful trip. Goodbye. No one cares what you're doing. They care about themselves. Be part of it. And then obviously we are all about, in our business at F Street, it's about the hustle. It never stops. It's 24/7. It never goes away. It never rests. It always is an opportunity. There's always a deal. There's always something happening. Always. There were foreclosures when the first day of mortgage was created, there was a foreclosure. There's foreclosures today. There's foreclosures in 2027. There's always opportunity. There's always stuff moving around. Be active. Be in the hustle. So we talked briefly about syndication, and everyone always asks me, how do you get these people? How do you talk to someone about money? I'm scared to talk about money with people, right? I'm scared to ask somebody, hello, sir, can you make a $250,000 investment into my project? It starts with confidence. It starts with you understanding what you're doing. And then it starts with your success roles. Success follows success. So start with the syndication pool. Who wants to syndicate a duplex? I'm going to buy it for 100 grand. I need $20,000 or $30,000. Who can syndicate a duplex today in their network for 30 grand? Raise your hand. Right? Start there. If you didn't raise your hand and you're interested in growing, start with a duplex. Start with the good old experiment. We're going to do a duplex. I'm going to raise money. I'm going to pay my investors the return. I'm going to grow rent. I'm going to drive NOI. I'm going to drive value. I'm going to refinance. I'm going to get everyone their money back. And then I'm going to go to the next deal with them. And I'm going to ask them about their mother, their brother, their sisters. Create your investor database, your initial investors. Talk to them about real estate, guys. How many people are going out and speaking to their investors or potential investors about real estate every day? You should. Go do it. Your reputation means everything to you. How do you get a bad reputation? Well, you have a lot of dumb people that don't know what they're talking about, that talk shit about you. That's not your reputation. Your reputation is when you talk to your lender and you say to your lender, what do you think about Scott? And he says, he's dependable, reliable, and he's never missed a payment. That's my reputation. When you talk to my investors and say, every single month my check is in, my deposit on time, every single month with never an exception, that's my reputation. What people say about me outside of that world means absolutely nothing to me. I could care less. What's even more comical is when you read about them and they say, oh, you're doing all these crazy things. They don't even know what they're talking about. I said, how did you even learn all this stuff? Because you don't even know what you're saying. So don't worry about the riffraff. Build your network and your reputation by who you are as a person. Let people judge you for what you have done. Your track record speaks 100% of who you are. Every single time it's about your track record. I go back to my track record and say, here's what I've done that I've been successful on. Here's what I've done. Oh, and by the way, if you'd like to call Ricky Schneider and ask him about my last deal, he's in the room right now and he can tell you about it. Or if you'd like to talk about to this individual who's been an investor since 2009, he'll speak to you. That's my track record. That's how you do it. Then create the power of real estate. What is the most powerful part about real estate is leverage, right? Leverage what we're doing. Leverage everything. Leverage your network, leverage your banks, leverage your opportunity to grow, leverage efficiently. And then obviously understand your risk in your network. Your risk profile is where you want to be. If you're scared about your first syndication and you want to do a nice Shorewood duplex, that might be $250,000. That's okay. Now you're going to have to raise $70,000. That's okay too. Go do it. Go hustle. How hard will you work for $1 million? So how do we create value in what we're doing in real estate? How do you drive value? This is one of the things that has made real estate so powerful. This right here. Think about this. If I told somebody that I can get you $3,600 a year of additional NOI and that's going to yield you $60,000 of value, you'd all probably say you're crazy, except if it's in real estate, you'd say, holy shit, that's amazing. Let's do that 100 more times. So creating value in real estate, it can happen two ways. You can increase your revenue or you can reduce your expenses, right? Very simple. Every other algorithm that's out there is not as smart as that statement. You can increase your NOI by increasing top line number revenue or lowering your expenses. Those two formulas get to your NOI. So I always tell people this from the power of real estate. When you make very, very small changes, a $300 increase in monthly income, if you have a duplex and they're each paying $600 and you charge $750, that's $300. Right? Simple math. I didn't even need a calculator. And if you then reduce your monthly expenses by charging them for the water bill, that costs each side $150 a month, or to do the snow, or to cut the grass, right? Now you have saved, either way, $300. You can do it one of two ways. And $300 equals how much a year of NOI savings? $3,600, either top line increase or bottom line decrease. And that at a 6 cap gets you $60,000 of value. Think about that. A $150 per side rent increase on a duplex gets you $60,000 of value. I hope you're blown away by just the simple math of that. Because that's not even a lot of money. If you were to take a 200,000 square foot industrial space and get from $650 to $750 in rent, you get $200,000 of NOI. That's powerful. And if you did the double side of it, where you save the $300 on revenue by increasing it $300 and you reduce your expenses by $300, how much value have you created? $120,000, and you did that probably without blowing your nose, sniffing, coughing, or doing any much of heavy lifting. Tenant, it's now $750 on your new lease, and you guys are paying the water. Thank you. Here's my $120,000. That's the power of real estate. That's right there. This slide, this simple notion is why all of you are here, whether you know it or not. At some point, you'll know you're here for this. If you can get to the dual impact of getting $600, you get $120,000 in your pocket of value. That's wealth. That's real money. And what if you could borrow off of that at 70% or 50%? You can put $60,000, at 50% loan, you can put $60,000 in your pocket. Who wants 60 grand today? Okay, go raise your rents $150 and go cut your expenses by $150 aside. So obviously, part of who we are at F Street and part of my whole belief is obviously creating value for my partners, my customers. We briefly talked about this, but my investors are my lifeline. Your investors are your lifeline. Your strategic partners are your lifeline. Your tenants, people treat their tenants like shit. They're the largest payment they make every month is to you, 90% of the time. Think about that. 90% of the time, the person writing the check, the number one person they pay every month is their landlord. Yet we don't treat them the way they should be. And so you have turnover. But if you were kind and nice, courteous, and considerate, and were fair, because they do take advantage of you, you could keep the retention of them longer. And then obviously for me, it's about my partners, my lenders, my builders, my title companies, the escrow agents, everybody that in my ecosystem, I want to know intimately. I want to have a relationship with. Some days are bad days. Some days I have to call my GC and tell them I'm tired of the change orders. And we have to have a tough conversation, but it's still good conversation. So with that, I'd like to open up. First of all, I'd like to thank you all for being here. I'd like to thank Brock and Jeff for hosting me today. I'd like to open up for a little Q&A. If anyone has any questions, anything's open for discussion. We've got, I don't know how much time, Brock. Okay, so we got a couple minutes for a couple questions. And then obviously, those are our townhouses that we're building right now. So I wanted to put you in a beautiful Zen moment while you're asking your questions. Anyone got anything? I can barely see. Yes, sir.
Hey, Scott, are you able to touch on your involvement with Coleman Yards and maybe briefly touch on your relationship with Josh Jeffers and your outlook on the project?
Yes, if we want to do that right now, if you're okay, we do it offline. You and I can have that discussion as soon as we get out of here. So he asked a question about, we have a portal, fstreet.com, which offers partnerships to create equity. He asked about a specific deal which Josh Jeffers, who's a local real estate developer, is developing a $110 million deal in Rockford. They're getting about $60 to $70 million of subsidy from the government. The city of Rockford really wants to make this happen. So the relationship is a co-development relationship. The success of the project obviously yielded by many disclaimers to a PPM, which I'm happy to go through with you. If you want to do that right after this, I'm happy to chat with you. If you'd like to do it on this forum, I can do that as well. I don't know if everyone's interested in hearing that discussion, so. Are you going to be here right after this? Yeah, we can talk. Okay, I'll jump right with you after this. Yeah. Tell me your name one more time. Hayden Pratt. Oh, hey, how's it going? My son's Hayden.
Hey, Scott. Nick Keys. So it's super interesting to hear you reference the $100,000 3 duplexes that you bought on the south side, sold them for $500, or you can pick out of your memory these very small transactions, and it sounds as if maybe you still do them, right? There's a deal always to be made. Is it at a certain point as you scale, do you stop working on those smaller projects? Like, do you say, all right, I can't focus my time on this anymore? Do you simply assign it to somebody else, or do you just take it off your plate altogether?
I wish it was that easy. It comes down to, at the end of the day, what is $100,000 still worth to you, right? And to me, it's still worth $100,000. And so I just can't say no. So as much as they become distractions, which they do, I still flipped 4 houses last year because I still look at opportunities that are in the smaller scale because they come to me just from being in the business for 20 years and having just the Rolodex of people that will call you to say, hey, solve this problem. The answer is I still do it all. I still try to do it all. It just sometimes time is what prevails, and I'll end up either passing it on to someone else or someone else in our team will do it, or one of our other aspiring investors that's in our network will take it on. But I struggle there. It's a personal struggle where I want to obviously do everything.
Thank you, Scott. Logan Lindstrom. How reliant are you on your team, right? You have all these different projects going on, and I know that you have such a solid team, but how involved do you stay on everything you're doing?
Yeah, yeah, it's hard. It's one of those things where you mentioned, like, I feel like I have I feel like my memory for transaction and opportunity and deal and understanding deal is rapid, so I can stay in touch with everything relatively quickly. I wish I was involved. When you build buildings, you have OAC meetings where you're going weekly and discussing opportunities and challenges with the projects. I don't get to go to those every week. We have a project delivery individual who really keeps us up to date on that stuff, but I'm involved. I'm involved in our lending business where I'm looking at deals every single day, approving and denying loans. I'm actively involved in everything I do because that's just how it works for my ecosystem. We have a great team. I trust everybody implicitly, but being involved is what keeps my connection between me, the business, and my investors.
Do you find yourself making decisions fast?
Yes, as quick as I can. I'm a go. If I make a mistake, we got to clean it up, but we'll clean it up. And so I always know the decisions that you're making are ones that we can always solve for. The decisions that I do make from time to time. Right now, we're in a conundrum where we have a project in Tyler, Texas, and it's a 112-unit apartment complex conversion from hotel to, and I'm evaluating interest rates right now. And so I don't know what to do because our investors, we have $2.8 million of investor dollars in there. I can pay them off $2.2 million, not all the 2.8, but interest rates are at 6.1 on a 35-year HUD amortizing loan. So we're making decisions, and that one's taking me a little longer just because everyone says interest rates are going to go down next year, and if they go down next year, I'm stuck in a 35-year with a 10-year prepayment penalty. So there's a lot of decisions that happen. We try to make them quick and efficiently with the best knowledge that we have to be effective. Yeah, thanks, Logan.
Who else?
Hi, my name is Marcelo Sharif with Ambitions Capital. Last year, my team, we bought over 413 units, actually in the past 2 years. Do you guys JV with other people outside of the state?
So we do deals outside of the state, yes. Do we JV? JVs get complicated, right? Because you have to really trust your partner, right? And so I've seen it even on small duplexes where, oh, this guy was going to do this and he took my money and ran. And I don't understand where they run to with the money because the money's gone by the time they run, and then I never really understand where they stop. It's always comical to me. It's a little bit unique to me. We have people that file, I'm digressing. We have people that we file foreclosure, they file bankruptcy, don't show up for the bankruptcy hearing, and then 3 weeks later we finish the foreclosure. I'm like, well, what were you trying to get done here? Because the means don't justify the ends. So to answer your question, we look at every opportunity that's out there. Congratulations on the 400 units you've acquired. That's a big victory. I don't think there's many in the room that have acquired 400 units in the last 2 years, so be proud of that. If there's a deal, I'd love to see it. I don't want to say no to anything other than we look for dependable, reliable JV partners in the event that we do JV so that we can obviously keep moving forward. There you go. Thanks.
All right, Scott. Yeah, thanks for coming. My name is Mike Bauer. You're building in West Bend. Quick question, not the main one, but where in West Bend?
It's on Forest and Main.
Gotcha. I live in West Bend, got some property there. Question for you. I haven't syndicated anything yet. I think that is for a lot of us. We're wondering, can you just give us a high level of like when you put together your first syndication deal? I've got a background of having 10 years of real estate, but I just want to understand when you put that first syndication together, what are some of the main things on how you develop that? How do you create that outside of getting the right people around you?
Yeah, great question. So we do it pretty simple. We do it with as much simplicity as possible so the investors understand it. And that's the most important part. Can you sell it? And if you can't sell it because it's so complicated with IRR hurdles and different methods, you might as well talk turkey to these people because they're going to walk away from you because it's just too scary for them. So we do it very simply. You keep 50%, we keep 50%. We pay you an 8% preferred return on your money while your money's outstanding. I take nothing until you have all your money back. Once you have all your money back, I split with you 50-50. Pretty simple, right? So it's a long-term game for us, right? We got to get all your money back and return on the cash flow. We just finished Brown Deere, for example. We have 3.2 remaining years. Now it's three years remaining of cash flow back to the investors. We're distributing out about $92,000 a month to the investors. Once that all happens, the $92,000 investor payment goes $45,000 to F Street, $45,000 to investors. And so we keep it really simple, right? We were at a 7% preferred return. Now we're at an 8% preferred return. Preferred return is just in the waterfalls. It's accruing and growing as a preference after all of our obligations to municipalities, et cetera, and mortgages. So preference goes to the investor under the return, and then we start repaying the principal. So if you made a $100,000 investment, year one, we owe you 108. Year two, we owe you 116. Year three, I start paying down that 116, and I only owe you 100, let's just say. And then over the next 36 months, I'm paying you off on the rest of it, or refinancing. It all depends on where we are in that cycle. So simple, we use documents. There's two things to also remember. There's a SEC requirement under the Form D, which is an SEC requirement that says you're raising money. And you can raise money on your own under the 506B, which allows you to raise money up to 2,000 potential investors. If you go under general solicitation, which is the 506C, you have to no longer allow for self-accreditation, but you use a third party to accreditate. All right, guys. Brock, Jeff, thank you for being. Thanks for having me. All of you, lovely people, thanks for being here. Have a great conference.